Before we go jump into a trading plan, let's go over current market conditions, right? This is first broadcast since the financial dislocations, right? Several banks went bankrupt, right? SVB, I think, filed for bankruptcy today. Silicon Valley Bank filed for bankruptcy. You have First Republic Bank precipitously dropping. And we have, so what are the news, right? I mean, first of all, I don't know how much you want me to spend going over what is happening. I'll do a quick my understanding, right? The idea that Silicon Valley Bank was a little bit different, right? It was a unique bank in terms of most of the Silicon Valley, that name, companies, right? Startups would invest, not would invest, but would deposit their money, right? Proceeds from raising capital, just all of their balance sheet was, all of the cash was, and investments were sitting at Silicon Valley. So primarily these were startups that had a lot, in the past 10 years, accumulated a lot of wealth, right? Because a lot of people were investing into startups, cryptocurrencies. And the Silicon Valley Bank in turn took that money. What do you do with that cash? You would invest into bonds, mortgage-backed securities, and then you do have this situation where a lot of the startups, they have issues with raising cash right now. They have issues with cash flow. So any companies that have negative balance sheet, right? They need to withdraw their deposits, right? So you have this run on banks where everybody's trying to withdraw money at the same time, right? Like in good old days during Great Depression or in the 1800s. And if banks doesn't have enough liquidity, and then they have to go file for bankruptcy, because even though they invested into what considered to be a high-grade corporate bonds or treasuries, because interest rates went from 0 to 5%, right? Interest rates went from 0 to 5%. You have to mark down their asset classes, right? So that's Silicon Valley Bank. The question is this an exception, right? Banks go bankrupt, not all the time, but often, right? Quite often, and it doesn't result in financial crisis every time. So the headlines that drive the market now, you have like went to the Wall Street Journal, main article is Target Global writes down venture funds by 33%, right? So the idea that if you have now banks or hedge funds and you invest into different companies, right? You invest into different companies, these companies are worth a lot less right now, right? Because their balance sheet also has, most of the companies, where do they invest? They invest in other companies, they invest into corporate bonds. It's the same idea, right? So now they're marking down. I mean, this is an extreme case, right? 33% is an extreme case, but these headlines will continue on, right? They will continue on because that is an issue, right? You have to mark down your assets, right? Banks are obligated by the regulators, right? And these rules will become more stricter, right? Because we roll back the Dodd-Frank Act. Now we have to get some version back to make sure this doesn't happen again. But from hedge funds to now, we're gonna go into the next earnings season. You will see this more often than not, that there has to be a markdown of the assets that are on the balance sheet, right? It's going to be like a domino effect. So that's the news that are driven to the downside, whether it's a Credit Suisse, right, that has liquidity issues and has to raise cash, whether it's the First Bank, now it's private equity, and most likely it's going to continue on into other asset classes, or private equity, hedge funds, S&P 500 companies. So that's one of the main headlines. What else is in the Wall Street Journal? So Silicon Valley, right, filed for bankruptcy protection, right? China, visiting Moscow, right? Geopolitical risk between China, Russia, Ukraine, United States. And the macroeconomic news, right? We just had a release of US leading indicators, right? Let me see this refresh. That's done. So we did have leading economic indicators, again, down. I think expectation was 0.4. It was either 0.4 or 0.3. And consumer sentiment dropped significantly. Expectation was 67. I think it dropped to 64, right? And inflation expectation also dropped, right? So that's another set of headline news. So these are the negative headline news, right? Negative headline news. You have a lot of volatility in 2-year yield. So the word liquidity is used on daily basis, right? Lack of liquidity in treasury market, in high yield junk bonds. And the yield has been very volatile, right? Which shows distress, right? Usually what 2-year yield should not move 5–10% every single day, right? That shows instability in the credit market. So that's another set of news. The positive news are inflation are down, right? 2-year yield dropped significantly, right? From 5 to now dip below 4%, right? And you can see technology is actually rallying, right? So very unusual, right? It was the idea that, again, lower interest rate is good for high beta stocks because they can refinance their debt. On one hand, they have to write down their assets. But on the other hand, when they have to refinance some of these debt, it will be at much lower interest rate, which is one of the reasons technology is going higher. And the positive headline news, GDP is still expectation 3% Q1, still low unemployment rate, right? Consumers are still traveling and going to hotels, and the economy is strong, right? So you have this story of tale of two stories, right? You have two different versions, right? The positive and the negative. And somebody on the news said that this is like Chinese chamber torture, right? We're referring to chamber torture, right? For traders. I don't know if it's a chamber torture, but the idea is that, like any other argument, there is a pros and cons, right? You just have to decide which camp you're going to be on, right? There's a bear camp, right? Bear camp basically says, listen, every time you raise interest rates, you're going to have systemic issues. Somewhere things going to break, right? That was one of the main arguments for bears, right? And now you see evidence, right? You actually see concrete evidence where this is started to happen. Maybe it's not systematic, maybe it's just in few places, but you already see evidence, right? So that's bear camp, right? The bull camp is, as long as unemployment is low and people are spending money, we're a service-based economy, this is just a temporary hiccups, right? And the market continues to go higher. My point of view, if you were bull and you were in a soft landing or no landing camp, I propose to at least start hedging your portfolio, right? At least start hedging your portfolio. You can find on Tradespoon, we have several ways. If you would go to Elite Service and you find, go to my positions and orders, right? You can always go to positions and orders. You can see different ways I hedge using stock or options, right? Silver, treasury, gold, dollar, right? There's or options, like if you put spreads. So if you're a bear, if you're a bull, I would consider to be hedge your positions. And we did have a breakdown, right? We did have a breakdown. Right, we did break the previous downtrend, right? Starting in January, right? We broke the downtrend, and the bears had to scratch their heads, like, why are we breaking this? Why are we above this trend, right? And we still remain above this downtrend. We still remain above the downtrend, the previous downtrend, until we had a breakout in January, because China is reopening and consumers are traveling, life is good. So now we're still trading kind of in this uptrend. So my point is that you have a clearly defined now new downtrend. As long as we're below this downtrend, right? As long as we're downtrend, it's kind of the same situation, right? If we do break above this downtrend, like we did in January, right? Maybe some positive news, right? China is lowering capital requirements, right? So that should free up a lot of cash in China, reopening, they're buying oil, they're spending money, they're building, you know, that's a boost for economy. So if you see market go up above 410, you know, 420, kind of another breakout looks like this, then, you know, bears will start scratching their head and figure out, okay, what has changed? But until then, you know, bears are in control, right? Until then, bears are in control as long as we're now trading in this downtrend. If you're a bear, right, if you're a bear, I would not be aggressively bearish because you can clearly see we're still trading in this trend, right? We're still trading between these two trends, right? At some point, we will break below, right? We're either going to break below 390, right? Or we're going to break above this downtrend, right? Scenario 1, right? We break to the upside. Scenario 2, we break to the downside, right? And then the question of is the timing. When is this going to happen, right? So first question, let me pose to everybody. You know, do you think we're going to have, you know, by let's say June, right? By the end of this, we're almost done with Q1. We do have triple witching expiration, so just keep in mind there is a triple witching expiration today. Right, quarterly expires. So by Q2, by end of Q2, do you think we will break to the upside, or do you think we're going to break to the downside? Right, that's $1 million question. You can be a bull, you can be a bear, it doesn't really matter, right? What matters is, are we going to break December lows, or are we going to break through this downtrend? So let's pose the question to the audience. 1 or 2, are we breaking to the upside, no landing, or are we breaking to the downside, hard landing?